Hello and welcome to another timely episode of MC Explains, an investor education initiative brought to you by Moneycontrol and Invesco Mutual Fund. For equity investors, whether you invest directly or through mutual funds, it's a good feeling when the market moves up. Right now, the Sensex and Nifty 50 are at an all-time high, and you must be smiling each time you see the value of your equity portfolio jumping up. However, there are several experts who are also out there talking about reasonable valuations and no great earnings triggers in the near future. What if the market corrects from here? After all, what goes up must come down. Here's the thing you have to know about equity markets. Over decades now, there have been points in time where markets correct. At times, the corrections last a few months and at times a few years. The most recent sharp downturn in markets happened just as COVID was declared as a pandemic in the beginning of 2020. Before that, we had bouts of short periods of market correction, but the big one was in 2008 when globally equity markets collapsed and took more than a year to start moving up in a sustained manner once again. That happened from the all-time peak reached in January 2008. The chart shows how volatile markets can be in short periods, but the long-term trend has been upwards. Do you fear that another sharp correction is on the way, or is it going to be a long drawn-out correction? Or what if the market simply remains at this level for the next 9 to 12 months and it's a time correction rather than a price correction? Truth is, we don't know where the market is headed in the next 12 months, 6 months, or even in the next 1 week. We don't know what unseen global or local trigger can shake up prices and make them cascade lower, and when that will happen. What we do know is that market prices of listed equity stocks get impacted by all kinds of noise and move up and down on a daily basis. If you are invested in a good quality portfolio, prices and outcomes will ultimately track earnings growth potential of the company directly and the economy indirectly. We also know that despite all the calamities across the globe in the last 100 years, no stock market has gone to zero. Prices recover and quality sustains over time. In a mutual fund portfolio, the fund manager is also moving the portfolio stocks around, picking undervalued stocks even at market peaks, and more importantly, selling out of richly valued stocks at a gain. Hence, despite seeing a market peak, you should know that a good quality managed fund portfolio like an equity mutual fund is structured and managed to weather storms. You may see your NAV falling in a correction, but ultimately you have to remain invested through at least a 7 to 8 year traditional business cycle to see gains compounding. When it comes to selling or redeeming your funds, ideally, the redemption time should match the time where your goals are nearing completion, and it's prudent to remain committed to your asset allocation. You can also invest regularly through systematic investment plans or SIPs that mutual funds offer. Continuing your SIPs or regular investment through a potential correction from a market peak allows you to gather units at a lower price, thus enhancing return when the market starts moving back up. Withdrawing at a market peak and then regretting not being fully invested if the market continues to move up is a financially inefficient situation for long-term investments. Equity markets are non-linear and some years can witness correction, but you may not be able to predict that in advance. It's best to time your exits only according to your goals rather than the market mood.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.